Welcome to STOA. This is your place to become the confident protector of the wealth that you've built, earned, or inherited. Today, we're going to break down one of the most common pieces of investment advice out there. After spending more than 7 years totally immersed in the financial markets, I'm talking thousands of hours figuring out what really works, we've pinpointed a critical flaw that, honestly, most investors just completely miss. We're going to show you how to start thinking like a professional capital owner so you can avoid it.
A lot of the successful founders and executives we've worked with, everywhere from Dubai to New York, they initially relied on their gut. But let's be real, the market can be incredibly overwhelming, right? And that often leads to emotional choices instead of just following a solid system. The real goal here is to build a financial operation that runs like a well-oiled machine, not a casino gamble. Let's explore exactly how to do that.
Okay, before we really dive in, I want you to do something for me. To get the absolute most out of what I'm about to share, I want you to imagine you just paid $10,000 for this insight. Give it that level of focus, because that's the kind of attention that truly leads to real transformation. So, you ready? Let's get started. A lot of people consider this next thing the holy grail of investing. It's a super simple, passive strategy that basically promises you wealth with, well, minimal effort. But the real question is, does this widely praised approach actually hold up when things get tough? We're about to put it to the test.
And here it is. This is the core problem we're digging into today. The most popular investment strategy on the planet has a huge hidden flaw. It looks absolutely brilliant right up until the moment it fails. And when it fails, it can have devastating consequences for your portfolio. So what are we actually talking about here? Buy and hold is exactly what it sounds like. It's a simple strategy. You buy assets, maybe some stocks or index funds, and you just hold on to them for a really long time. We're talking 10 years, maybe more, no matter what the market is doing. You just ride out all the waves, good and bad.
And look, let's be fair, this strategy is popular for some very, very good reasons. It's incredibly easy to do, it's super tax efficient since you're aiming for those long-term capital gains, and you save a ton on fees. You really don't have to be some kind of market wizard. You just buy a low-cost index fund or an ETF and you wait. Sounds pretty perfect, doesn't it?
But this is where the cracks in that holy grail start to appear. There are some really serious disadvantages that are often completely ignored, especially when the markets are flying high and everyone, and I mean everyone, feels like a genius.
And the difference is just it's night and day. In a bull market, when stocks are just going up and up, buy and hold looks like the most brilliant strategy ever invented. But in a bear market, the reality is brutal. Your portfolio value can drop or just go completely flat for years, and that's when the hold part of the plan just shatters. Panic kicks in, and investors end up selling at the absolute worst possible time, right at the bottom.
This quote from James Grant just nails the dangerous psychology at play here. The buy and hold philosophy can accidentally encourage people to pile into the market when prices are already sky high, because that's when everything feels the safest. It's the complete opposite of how we act as shoppers everywhere else in our lives. Think about it.
Okay, so if a simple passive strategy has these kinds of hidden dangers, then surely the pros do better, right? You'd think the highly paid, legendary hedge fund managers would be able to navigate these cycles and just blow the market away. Well, let's find out.
First things first, let's talk about what it costs to hire these pros. Hedge funds are famous for what's called the 2 and 20 fee structure. What that means is they charge you 2% of your entire investment every single year, whether they make you money or not. Plus, they take 20% of any profits they generate. For that kind of cash, you'd be expecting some pretty incredible results.
And that brings us to the billion-dollar question. After you pay those eye-watering fees, do these elite managers actually deliver the amazing returns they promise? Are they really worth the price of admission?
And the answer, on average, is a huge, resounding no. I mean, just look at this data from 2011 to 2020. A simple, dirt-cheap S&P 500 index fund returned an average of 14.4% a year. The average hedge fund, a measly 5.0%. The passive index didn't just win, it absolutely crushed the high-priced managers. It wasn't even close.
This was actually the whole idea behind Warren Buffett's famous 10-year bet. He wagered that a simple index fund would beat a basket of hedge funds. And guess what? He won. Easily. His point is so clear. Market performance is unpredictable. But those high fees you're paying to active managers, they are relentless. They are constant. They never go away.
So this creates a really interesting puzzle, right? If hedge funds consistently underperform the market and charge these insane fees, why on earth do the world's wealthiest people and institutions still give them billions of dollars to manage?
And here is the crucial insight. Once you've built significant wealth, your primary goal completely shifts. It's not just about aggressive growth anymore. It's about protecting what you've got. The game changes from wealth creation to wealth preservation. The rich aren't always paying for higher returns. They're paying for a smoother, safer ride.
And this right here is where hedge funds actually show their true value. Take the 2008 financial crisis. The S&P 500 lost a catastrophic 37%. The average hedge fund, though, lost significantly less, about 22%. Now, they didn't make money, but they provided a critical buffer during a total market meltdown. They preserved capital.
We can actually put a number on this risk reduction by looking at something called volatility. Just think of it as how bumpy the ride is. Over almost 30 years, the S&P 500 had a volatility of about 14.9%. Hedge funds? Less than half that, at just 6.79%. Their main job is to deliver a much smoother ride, especially on the way down.
So where does that leave you? The big takeaway here isn't that you have to pick a side, that you have to be either a passive investor or go pay for an expensive active manager. No, the real lesson is that you need to move beyond that false choice and start building a robust, strategic plan for your own capital. A true capital owner always operates from a framework. First, you have to clearly define your goals. Are you trying to grow or are you trying to preserve? Second, you need clear rules for when you buy, not just what you buy. Third, and this is absolutely critical, you have to have predefined rules for selling. This is what takes the emotion out of it and prevents you from panicking. And finally, you have to review and adjust your portfolio systematically.
Which really leaves you with one crucial question to ask yourself. Are you just chasing returns? Building a portfolio that only looks great when the market is going up? Or are you building a resilient financial operation that's actually designed to withstand the inevitable storms and is truly built to last?
Look, if you've made it this far, you're serious, and that is exactly who STOA is for. We operate on an application-only basis because we work with individuals who are truly ready to elevate their game. So, if you're tired of wasting hours just chasing noise and you want to implement a proven process that delivers results in less than 90 minutes a day, I invite you to apply now. Seats are limited, and once they're filled, they're gone for the quarter. Just click the link in the description to fill out a brief application. And hey, if you found this content valuable, please share it with another capital owner you know. And don't forget to like, subscribe, and leave a comment below. I look forward to connecting with you next time. Here's to your success.